Well, earnings is in full swing, earnings season. We're back with John Ing to see how he evaluates a set of gold company financial results. How does an expert break down the multi-page reports? The results from Agnico Eagle Mines are more than 50 pages long this morning. How do you cut through all of that information to come up with some valuable information that can tell you how a gold company is faring in what can be a very difficult sector? Here's a look at what John Ing looks at. We asked John early this morning, what are 4 or 5 things to look at from a set of results? And we'll refer to this through our conversation. All-in sustaining costs, often identified in gold sector results by the acronym AISC. The market cap of production, which John will explain. The market cap of reserves. The exploration budget. And the balance sheet. 5 things that this longtime expert in the sector looks at when he sits down with a set of fresh gold sector results. And he's done so just this morning with the numbers from Agnico Eagle and Newmont Gold. John, thanks again for being with us. Let's talk about all-in sustaining costs. How do they compare, for instance, with cash costs of production, which for many years was the standard?
Well, there are 2 levels of costs, and it's sort of like your own budget, is that you get X amount of dollars to build a home, but there's all the ancillary costs. And when you talk about all-in costs, there's exploration costs that's included. There's depreciation included. So it's an all-in cost. So it's a better indication as opposed to just a cash cost.
And let's go to what you refer to as the market cap of production. Talk to us about that. What do you mean by market cap?
Well, gold producers are always optimistic, and they are always talking about increase in production. And what I look at is I want to compare that production increase to its peers. And so I take the market cap and against the production, and that gives me an idea as to which producers are better. Now, there are some jurisdictions which are more riskier, so you have to account for that. Similarly, market cap per reserves. Reserves are all important for a mining company. After all, they are mining it and they have to replace it. And the problem with the mining industry is that since 2019, production has been going down. Reserves have been going down. Agnico Eagle, in the latest, they bumped up their reserves through an acquisition of the balance of Canadian Malartic. That's one of the reasons why you have all these takeovers, is that because reserves are declining, that it's actually cheaper on Bay Street now to buy reserves than to go and explore. Because when you explore, you have to spend money, but it can take you 10 years to put a mine into production. And that's a very long time for somebody to wait to put all that money. So market cap per reserves gives you an idea as to what producers, and on average, they're trading at pretty lows at this time.
Okay, very quickly, the balance sheet. What lines do you look at on the balance sheet?
Oh, unquestionably, free cash flow. Barrick had a debt problem. Then you'll have to look at what their free cash flow, how much debt do they have. So there's no question that the balance sheet dictates as to whether you should like it or avoid it or whatever. But the key, really, Paul, is the gold price. And a rising tide lifts all boats. And my expectation is in the near term, gold's going to go to $3,000. It's hated by most people, but there's unquestionably, it's a great hedge right now. And gold mines, there's not enough gold mines. There's only 400 mines in the world. There's less than 20 odd mines that produce 500,000 ounces. So there's a shortage. That's why I expect that there's going to be a lot more acquisitions.